Okay, I'm just signing. I'm letting people sign in. Just give a couple of minutes.
Morning, Michael.
Hey, hi George. Thank you so much for coming. I'm really happy I got to meet you. Really, really nice. Thank you so much. We had some nice time. I wouldn't say that the coffee was particularly nice, but it was a nice time we had. Um, yeah, you know, being a European, it's kind of like, I'm quite agnostic about where I live and that kind of stuff, but when it takes something away from you, like the coffee is like, that's one of the things that I kind of miss. So okay, I've got to kind of, I'll just give it another couple of seconds. I'm really grateful for the turnout. I haven't been here for 2 weeks. The first week I was unwell, and then the second week I was traveling back from America. So I kind of wanted to talk. So I got 5 things that I felt that I wanted to talk about. These are some mistakes that kind of easy to avoid. I use this as a reference, but you can use whatever reference you want. Like, if you're kind of like a below average chess player, there are some things that you can do to just improve your game. Just for example, like don't give out your queen. So there are some things that we can do as investors that if we just make fewer mistakes, then things will take care of themselves a lot easier. So just going to go through a few things like that. So I've got kind of 5 points that I feel are helpful to think about. This presently, my mind is kind of going about that you can't really outperform the market when the market's particularly hot. And the problem with investing is that people, the investing is really difficult, and people kind of lose their motivation when the market's kind of going sideways, or kind of when the sell-offs are coming in. And I understand that, right? It is a full-time job, and I try my best. I try my hardest to just give you the names that I feel, okay, this is what you need to do. I kind of put it in bold letters, like trade alert. I try my best. Like most of the things that I do, you can just ignore. Like the vast majority of what I say, you can just ignore. I know my wife and my daughter do, so you can do the same. When I put trade alert on the email, that's the only time you need to act. And those are quite rare. But when those do happen, you do need to act. Now, it's really important to kind of understand what we're trying to do. So I call myself an inflection investor. So what I'm trying, my job, my only thing that I need to do in my life is to try and figure out what will people be willing to pay for my business next year? Really? How will people's perception of the business change? Will it change or not? Really? That's really what I'm trying to do. So I'll give you a concrete example, because I believe these are kind of helpful when I give you a concrete example. And it's kind of nice when I give an example of something that's kind of, people are kind of edgy and nervous. So kind of like puts it out there, hopefully opens up the conversation for people to kind of think, and maybe they feel like motivated to talk about it and ask a question, etc. So with GigaCloud, so like it's a stock that it kind of goes up, goes down, goes up, goes down. Like, oh my God, that's gut wrenching. And I get that, right? So when I see a potential for a different narrative to come to fruition next year, those narratives, it's not like black and white. It's kind of starts moving in like a wave. And like a wave, it kind of takes some time to build up. And I don't know if you guys ever been surfing or not, but sometimes like you're kind of out in the water and you're kind of paddling, and like this big wave is coming your way, and you're like, and by the time it hits you, it's like it just fizzles out. The whole thing fizzles out, and you kind of have to wait for the next wave. But it will come. That wave will come. But these narratives, some kind of time, they kind of, you can see the things are developing, and they kind of start to surface. And then it kind of takes a bit of a slowdown, and people are like, you know what? Gig Clouds, it's a Chinese company, blah, blah, blah. Insiders are selling, blah, blah, blah. Whatever you want to kind of add in there. I'm sure you can add some your own kind of nuggets there. And, you know, when it comes to investing, you need to have this at the front of your mind, you know, that these narratives, bullish and bearish narratives, surface over the course of several months. Sometimes you kind of, everyone is like seeing on the same side, and sometimes people kind of get carried away, and the share price takes a breather, and then it's all kind of the bearish sentiment resurfaces. So if you take nothing from here, nothing from here, take this one thing, okay? Please, when you buy into a stock, have a tiny bit of patience. You don't need to like hold on for 5 years, but just kind of a tiny bit, like a few months, okay? 6 months. And sometimes, you know, the market kind of goes off on these risk-off sentiment periods, and it feels like it's lasting forever, and it's like gut-wrenching, and it's painful, it's like this, and it's that, and it's the other. But I promise you, I've been through this so many times, that the market will come back, and it's when people kind of lose excitement. It kind of starts coming back up, the market, and it's when people kind of get distracted with their lives and kind of forget about it. And that's really when things start to resurface. And I actually believe that, you know, a lot of people say, that like retail investors don't know how to invest and this and that. I think that nobody really knows, including myself, really knows how to invest. Or perhaps, better said, that investing is really, really difficult. Now, there's an advantage and a disadvantage to being a small account investor, like a passive investor or retail investor. The disadvantage is that you might not have a lot of time available, okay? You might, you know, you're busy, you got your wife, your daughter, your kid, whatever, your dog, time consuming. And you might feel like someone knows more about your stock, and that they are causing something, right? That they might see something. Nobody sees anything. Everyone like is as idiotic as the rest of us, okay? So for me, I try and help you by saying, okay, I will underwrite this business for 12 months. Anytime I put like a buy rating and say, okay, you can buy this, I will underwrite it. Now, I make mistakes as well, and we can discuss that in a moment. I've got the topic on that as well. But assuming more or less in the ballpark that you kind of pick out 5 of my stocks and equally weight them, I underwrite those stocks for 12 months. I know that I will make mistakes, but buy and hold, sorry, not buy and hold, but in the grand scheme of things, holding those 5 equally weighted stocks for 12 months kind of works out. Now, it doesn't work out every single day, and it doesn't work out every single week, but it does. It does. It certainly does. Okay. So the second point I kind of wanted to discuss is about this timing the market. You know, a lot of people kind of like wrote to me privately. I recommended Sizzle, my kind of retort to affirm buy now, pay later. And they go, oh my God, the market is like so hot. Like, I'm not going to buy this. And I get that. I fully get that. But it doesn't matter what the share price is doing today or did compared to what it was this morning. Nothing matters. Only matters is where the share price will be next year. And, you know, I suck at timing the market. I categorically suck, but I tell you this as a fact, right? I recommend a stock to you, like Auster. I was writing that thing up when I recommended it, and the share price, I kid you not, the share price was $9, and I'm writing, editing, this and that. Pre-market comes to $10. I'm like, oh, flipping heck. I'm writing as fast as I can. By the time I press submit, that thing was at $11. I'm like, oh, flipping heck, man. I'm like, whatever. Okay, $11. No sooner did I press send, and that thing was coming back to $10 to $9.80, $9, $8.50, $7.50. And I'm like, oh my goodness me, man. Like that, these things happen. You can't time these things. But today, obviously, the share price is up and everyone's happy, it's singing and dancing. But my point is that it's really difficult, because when you try and time the market, you're allowing your emotions to lead your decision.
Pinole circumscribed mass on the right.
Hold on a second, someone's chatting in the background.
Lateral breast.
Wait a second.
Anterior to middle depth demonstrates no significant change dating back to 126.19, compatible with a benign etiology, period.
Dave, can you mute yourself?
Sorry, I've been doing this for so long, man. I should actually learn one day how to use it soon. So anyway, it's really difficult to allow your emotions to lead your investment process. And I know I've been through these cycles. I know you will fail. I know you will fail doing that. Have a process for yourself. It doesn't need to be my process, but have a process for yourself, not to see a share price going one way or another and you having to react. I always say to people, space out your buying of a company's stock. Space it out, because the market, like I give you the example of Auster, the market can be very bullish today. Next week is dire. The month after that, it's back to normal. You can't time that. So just space it out. Now, point number 3. A lot of investors like to buy the dip. Buy the dip can work. It can work. But don't make this your first go-to process. Oh, the share price is down. I bought it at 10, therefore I'm gonna buy Auster at $7.50. Just cool it, Just don't make it a default reaction. Oh, the market got it wrong, I'm gonna buy, blah blah. Like, don't go to the market to prove your ego. You will get killed. Try to say, you know what, it's okay. I will see how things unfold. Cool it. I think that, but I feel that having a process that you go through where you stick to that process makes this a lot easier. So when it's like, for example, Auster is down, and I can look, okay, let's pretend for the sake of the discussion that I have some extra capital, and I look for my portfolio, got 20 stocks. I bought Auster last week. Do I really need to buy Auster this week, even though the share price is lower? Maybe there's something else in the portfolio that could be worthwhile that I haven't bought in a while. Now, simply thinking this up opens up your options, and it really, for my personality at least, this really helps me, because like a lot of people, a lot of investors, I'm very competitive, but putting out this question to myself and kind of say, hey, Michael, am I trying to prove my ego, or am I trying to outperform? And sometimes, a stock sells off and it could be a worthwhile investment. So like I believe LifeMD, for example, is sold off, and I believe that's an interesting investment. But that's not my default method of operation. I'm not like, okay, share price is down, I'm going all in, leverage. Like, I feel that those strategies end up with the investor underperforming the S&P. And I haven't got any data to give you that's recent. I've read a few books over time, but I haven't got like concrete data. I saw recently that the average investor delivers on their portfolio 3% a year versus the S&P about 7%. I probably believe it's actually less than that, than 3%. But have a process that your default reaction is not to buy the dip. It can be okay, but that is not the go-to process, okay? Now, I'm going to go up to point number 5. So this one is a bit controversial. This is my final point. The whole idea of investing in small caps versus large caps. Now, I do not believe that just because something is a small cap and it's underfollowed, it's necessarily undervalued. Sometimes underfollowed could be undervalued, but don't start just because I'm buying something that no one's talking about that is necessarily undervalued. Now, the second part of this is that when you buy into these kind of small caps, they are, less established businesses. So the share price will be a lot more volatile than buying something like Meta. Although, that being said, I have, in my experience, seen many times Meta implode 20-25% on the back of an earnings result. So, even Meta, I've seen Amazon as well, for that matter, like 20% down. So, but on a day-to-day basis, on the back of no news, those businesses will not be down 20% in a day. Whereas in small caps, they can easily be. The Fed says interest rates remaining high, everything, move, sell off. Now, once you've understood that they're going to be more volatile and you've appropriately sized your portfolio so that you can stomach that, once you've done that, I promise you, you can do quite well. But the cost of that is that you're going to have to put up with a lot more pain because those small caps are a lot more volatile. So I am mostly on the small cap side, but you as an investor may think, okay, you know what? I don't want to have these gut-wrenching periods. I will take from Michael like 5 of his stocks, but I'm going to buy the rest, let's say, NVIDIA, whatever else you want to buy. Because those businesses are going to be less volatile. And NVIDIA might be a bad example, but those more established businesses, because ultimately what you're trying to do is you're trying to position your portfolio to survive the future. That's what you're trying to do. You're trying to position your capital so that next year it may be worth at least as much as it's worth this year, and hopefully a tiny bit more. But a lot of people kind of get a bit get fuzzy feelings when the market is kind of on a risk-off sentiment, and they kind of get bored and this and that. But that's really where your work comes in, by having a plan so that when the market does go through those periods, you're not kind of caught flat. Remember, don't buy all your stocks in one go. Space it out. Try to think about what the business is aiming towards next year. And that's the end of my spiel for today. If you guys want to ask any questions, please reach out, ask me some questions. I know I have a lot more to waffle on here.
Michael, you just said space your buys, but as you said, you give trade alerts like to sell a stock. So when you sell, are you saying pretty much go ahead and just get rid of all of it, or space the sells out too?
Yeah, this is a very good question. Very few people have asked me this question. I like to just exit the position in one go. I like to buy it in, but I like to just clean out in one go. It's not a perfect strategy, but I kind of work my way in, and when I feel like, okay, the grand scheme of the thesis is already in the share price, then I'm kind of, I want to just go, because I know, and like you remember as well, when you overstay your welcome, man, that share price will just get killed. You like singing and dancing, and you're up like Palo Alto Networks, and you're like a hero, and you're like, oh, in the shower, and all of a sudden earnings come out and it's like boom, down 40%, and you're just like, oh my gosh, I just like wasted a year of my life. And so nowadays I kind of like, I'm a bit more brutal, and it's difficult. You know why it's difficult, George? Because when I say, okay, let's, the example of Palo Alto Networks, I say, okay, let's buy Palo Alto Networks, and it's doing well, okay, for example, hypothetically. And I say, okay, let's exit this stock now, and the share price is up, and people are like, oh, I don't want to, it's like a great company, and it's going well, and it's like, and people have all kinds of commitment issues, and it's like, and I'm the bad guy. And I used to kind of be bothered about that. I used to be kind of like, oh, you know, I don't want to annoy people, and like, I want to kind of ease out of it and this and that. But nowadays, I just feel like, man, you know, ultimately, I need to drive the performance, you know, and people get kind of emotional about stuff, and I understand that, man, you know, and I get it. They don't know me personally, like they maybe read a few things that I say, and they're kind of like, oh, he's like you know, jerk. And but I'm like, you know, at the end of the day, I need to drive the performance of the service, right? So yeah, I know it's never perfect, you know, and like for example, this tech resources, I kind of said, okay, you know, I want to exit, and like people right away started like, oh, you're misunderstanding, like the green movement is picking up steam, and in fact today, like I read about like yet again that this is picking up steam, and but you're never going to be winning, right? Whichever way it goes. So yeah, in a short answer, I just kind of, when I say I'm out, I just write it that day and I get out.
That makes sense to me, and thank you, Michael.
Thank you. There's a few more people in the call. If you want to ask a question, this is a good time. If you want.
Michael, with the stock like Sezzle, if I'm saying that right.
Yeah, no
Yeah, like you recommended in that day, it was like up 70%. So it just felt like that was maybe less than ideal timing because it's very volatile. Would you recommend, like, even if you recommend like a stock, I know it's not like about the timing, but still that feels like maybe wait a week and see what happens kind of thing? Or would you just like go for it and be like, okay, I anticipate based on your, you know, margins, you're like, you know,
you know, in hindsight, I could tell you the correct answer in hindsight. But I know myself, you know, this is the thing, when you invest, it's about getting to know yourself. And I always say that this is a business where as you grow as a person, it kind of, you grow your portfolio and it kind of mirrors, right? And I'll tell you the truth. After I recommended that stock, I recommended on Thursday on the back of the earnings, and I had very little cash. I put some cash. I wasn't able to kind of put full throttle on it. And on Monday, when I bought it more, it was $81. And you know, this, like in like 2 months, this could be at $40 again. I have no idea. But I know from experience that I will forget. You know, I've got a lot of things happening in my mind, in my life, and you know, if I don't want to be monitoring the share price every day and kind of like trying to be cute. If I feel that I've got a good upside here, I feel like if I've got a good upside, I think I'll be okay. I also particularly like businesses that, you know, we've been in a very fortunate period now, 2023, 2024, on the back of 2022. That a lot of these businesses kind of came from SPACs and stuff like that and just imploded. And a lot of the sentiment kind of washed out. And I feel like it's a good time to kind of pick stuff up that people are not really euphoric about. I also like to look, it's, you know, just kind of a little kind of, I like to look a little bit on Seeking Alpha to see if it's like quite popular there. People are kind of pumping it. And yeah, if people don't really like, has like a relatively small number of followers and stuff like that, I'm kind of like, okay, it's not really something that people are really keeping their eyes on. Yeah, and I also know, like, man, sometimes these things just run away as well, you know. As long as the valuation makes more or less sense, I will bite the bullet. And it's not perfect. I gave you the example before of Auster, that on the day I recommended, that stock was like a rocket going up, and after I recommended, it fell like 35%. Like, poof. I don't know. In short, I try to use my experience to say, okay, this will be higher next year, but I don't know whether it goes down in the interim or whatever. So, sorry, I know it's not like a perfect answer.
No, that's great. Thank you for that transparency.
Thank you. I like to try my best. It's difficult, you know. It's really, really difficult because, particularly in small caps, you know, like whenever like sentiment changes so much, just on the back of a tweet, like you seen today, like with Rory Kitty or yesterday, it's like a tweet comes out and it's like off to the races, and everyone's like, oh, it's like, and these small caps, they can really move really quickly. But I believe that over the course of the year, this kind of smooths out a lot of the noise, and your timing is never going to be great, man. It's never great. It's never great. And just finally, I wanted to also talk about this kind of thing about, like, a lot of people, I think, don't know if it was you, but someone else wrote to me as well, but this is a common thing. People say, oh, you put the price target and this and that, and it's already like so close to the price target. You know, I never know where the share price is going to go. I never know. And I put that just kind of get the discussion going. But I like to give my businesses a year. And sometimes they kind of move quickly. And I say, okay, like with GigaCloud, I kind of revised higher a few times, or MoneyLion. But sometimes I kind of like with AppLovin, I'm like, okay, you know, when this gets to about 105, I'm out. And again, you know, I kind of feel like I recommended it last August, and kind of we're coming close to that 12-month holding period. I'm not that excited to be like saying, oh, people buy this now. Kind of feel, okay, you can buy it if you've already held some. You want to average up a little bit, but don't be a hero. Don't start building the position now. There's other things that, you know, interesting like that. And I feel like, yeah, you have to be quite brutal and not let your emotions be carried away. Like I give the example of AppLovin. It's kind of like, okay, I feel like people are really, really reflecting a lot of that passion. For example, AppLovin, it's an advertising business, for goodness sake. It's not like, it's not going to be the next Snowflake. It's advertising. People get confused sometimes. So it's important to temper my enthusiasm, right? Yeah, it's kind of like you need to be quite disciplined in the sense that thinking about your holding period. You don't, once people start to reflect, but I'll give you a contra example. So I've owned Hims and Hers for 3 years. That's way over my holding period normally. But I just feel like people still hate this company. So yeah, I broke my rule there and I kind of let it, I'm kind of still holding it. I'm still recommending it. So it's not a perfect strategy, but I'm trying to kind of stick to that 12-month holding period. I've waffled on that answer a really long time. I'm very sorry about that. Does anyone else want to ask a question?
Thanks, Michael.
Do you still have big confidence in was that S stock?
S stock?
What is it? I'm sorry.
Sentinel
Oh,
One.
Sentinel One. Yeah, sorry. Yeah.
Yeah, Sentinel One. That's it.
I apologize. Yeah. I'm hoping I'm right on this one. I know that the stock sold off last quarter because their growth rate significantly slowed down. But my thesis wasn't contingent on. It's not about the growth rate. It's about this business reaching break even towards the back end of 2024. So my thesis is still in play. The share price took a breather. Let's see how it goes. I'm really passionate about this business. I am really hoping that I've got it right. Yeah, so like, I feel like, yes, George, I am very bullish on it, and I'm really hoping that when they report in a couple of weeks, probably 2 weeks now, and they report in like 2 weeks time that the share price will get a bit of a bid. I'm really hoping so. Yeah, let's see how it goes.
Okay, thank you. Oh, and by the way, let me tell everyone that you are for real. I met you in person. You're a great guy, fun to be with, and your energy, I can tell that you are very devoted and sincere in people and in all that you do, and that's the kind of person. So, I mean, really applaud you what you're doing and how you do it and your results. So,
Same here, same here.
George isn't paid by me, by the way. Just very nice guy. Thank you so much. Thank you. Does anyone else want to ask any questions? If not, I'll wrap it up for this week.
I'm sorry.
No, go for it. It's okay.
Okay, along the lines of the previous question, any comment you have on GitLab?
Yeah, so when GitLab reported, on the back of that, the share price had been moving up a lot. So it is only natural that people's near-term excitement has been reflected in the share price, and there was no fireworks on the back of those earnings results. But I'm very bullish. Like GitLab, Moneyline, Sentinel-1, man, I'm really bullish on these businesses. I really hope that, yeah. I said before, you know, I don't know how long you've been on the service or whatever. I'm running a competition in Switzerland, and we kind of put out 3 names each. There's me and like I think another 11 hedge fund guys. We put 3 names in that we kind of have to for the next 5 years. So the competition is called 2029. And you 3 names that I believe that will do really well. So whoever loses, so there's about I think 11 or 12, I can't remember now. Whoever loses the competition, when we meet up in Switzerland in January 2029, because we meet up every January, whoever loses will have to pay dinner for all of us. And in Switzerland, dinners are really expensive. And I put my 3 names, which is Moneyline, Gear Cloud, and Sentinel-1. And for now, Sentinel-1 is the only one that's dragging me down, but I'm very bullish on these 3 businesses. I feel that, yeah, I feel like these 3 businesses will do quite well, I think, in 2024.
Okay, thank you so much. It's just that I was today thinking about adding some Sentinel-1 and GitLab. So thank you.
Sorry. Wait, slow on 1 second. You said GitLab, or you said Gear Cloud? Because I was talking about Gear Cloud.
No, GitLab.
Sorry. Listen, I want to retract everything I just said. I put down. Sorry, let me just. Sorry, I apologize. I was talking about a different company with GitLab. I put it down to a hold. I'm not touching that business anymore. Like I'll see how it goes. Your name is Anna, I think. Anna.
Anna, yes.
Yeah. So I put this business down to a hold. I am not touching this business until I get another 2 quarters of results, and then I will see. Okay. I was too bullish on GitLab Technologies. I believed that they would increase their profitability, and I know that this quarter they're going to report now that they have this kind of conference that they haven't had in 3 years, blah blah. But the profitability I was expecting to be higher and moving quicker than it is. And in fact, I will highlight that this is one of the drawbacks of my strategy, is that when I get the profitability wrong, this is when I make a mistake. It's not so much about getting the revenue growth rate right. That's not really. It's so I'm kind of rushing here, but I put it down to a hold, and I will see in the next 2 quarters if it's significantly better than I expected. If not, I will just keep it for that 12-month holding period. I will not buy anymore. I will just slow down and just, just calm it down. Did that answer your question?
Okay. Yes, of course. It's just that I've seen some movement in the share price, and also the discussions or the fact that Google Alphabet has invested more in GitLab.
Okay.
So,
Allow me to tell you two things.
my mind speculates on that, yes.
So do not look to the share price as vindication of whether you're right or wrong in the short term, because that will confuse you and that will lead you on the wrong path. Do not do that. Secondly,
Okay.
there's always distracting information. Oh, Google's doing this, blah, blah, blah. The only thing that matters is what the future profitability of the business will be. What's happening right now, like that's distracting information. Don't, please, just give it some time.
Okay, thank you for the advice that you give all the time, which is so useful and so valuable. Thank you.
Vasilis, you had a question you want to ask?
Yeah, I don't know if you have time. So I started comparing a little bit the story of Temu, that is really fashionable now, with the story of Wish in the past, that, you know, it was really a big hype and then it died fast somehow. I don't know what happened there. And I have this kind of fear, but at the same time, I don't connect this to their actual numbers, the report. So I don't know, maybe it's completely irrelevant.
No, it's all relevant. First of all, everything that you're learning about different business models, add to your database knowledge. So it's all relevant. It absolutely is relevant. Secondly, personally, what I like about PDD, we're talking about Temu's PDD, is that this is a business that in China, they originally were hyper competitive. And for a long time, people were like, oh, this business will never be profitable, this and that and the other. And then all of a sudden, they became quite profitable. And then they started to expand to the US and to Europe. Now, perhaps there's a question mark whether the US will be too many tax hurdles or not. But for all intents and purposes, they have a really clean business model. So they're basically coming from like really cheap stuff, and everyone loves cheap stuff. Like everyone loves cheap merchandise. But also when you think about Temu, it's not just about the US and whether there'll be taxes or not on it. In Europe, Temu's starting to pick up quite a lot of momentum. And like you see that the numbers are very strong. So this is a management team that has a history of being very aggressive, getting people accustomed and in the habit of going to their platform. And then later on, they increase the prices and they drive profitability. I like businesses that have a management team that's done this before and they're trying to replicate that same model. With Wish, I don't feel that they had the profitability sorted out.
Okay, so I was thinking that, I don't know, is it possible that they would ever cheat somehow with the numbers, that we didn't see something? Or because it's really so cheap, it's too good to be true, so cheap. I cannot believe this stuff. Like I read an article comparing Amazon, Wish, and Temu, and for the same product, you could find it like 3 times cheaper. I mean, it was not a comprehensive comparison by any means, but yeah.
Well,
so it's possible to find out something later.
I don't know if you know this company called Dillard's. The ticker is DDS, Dillard's. So it's like everyone's like, oh, this company never has earnings calls, and it's a retailer basically. They kind of like an outlet store, and they're like, oh no, it hasn't got earnings calls, and the management don't really care about the shareholders, and that did not stop in 2021. It had gone nowhere, the share price, for like 2 years or so. It was just flat. And then in 2021, way after this whole COVID thing, it went up like 1,000%. So you don't need to know all the granularity. As long as the free cash flow is increasing, the share price will with time follow.
Okay.
Thank you so much, everyone, for the call. Thank you for coming. I hope to see some of you next week on Tuesday, and see you soon. Thank you.
Okay.
Thank you, Michael.
Thank you so much.
Thank you. Have a good afternoon.